Most investors think checking their portfolio every day makes them more responsible. But what if it's quietly making them poorer? Why do so many intelligent people refresh stock prices dozens of times a day, even when they know long-term investing rewards patience? What's really happening inside the mind?
That's one of the biggest paradoxes in investing. We tell ourselves we're staying informed, but often we're feeding our emotions instead of our wealth. The market becomes less of a tool for building financial freedom and more like a social media feed, constantly refreshed, always promising something new. Every green day gives a small emotional high, and every red day triggers anxiety. Before long, you're not investing anymore, you're reacting. Think about someone who wakes up, reaches for their phone before even getting out of bed, and checks their portfolio. If it's up, the day starts with confidence. If it's down, suddenly everything feels uncertain. Yet nothing about the underlying businesses may have changed overnight. Only the prices did. That's the psychology of investing in action. Behavioral finance teaches us that humans feel the pain of losses much more intensely than the joy of equivalent gains. A $100,000 loss hurts far more than a $100,000 gain feels good. That's called loss aversion, and it's why a temporary dip can tempt investors into making permanent mistakes. There's another trap, the illusion of control. We assume that because we're watching the market closely, we're somehow influencing the outcome. But monitoring your investments every hour doesn't improve their performance any more than opening the oven every minute helps a cake bake faster. It only interrupts the process. The greatest investors understand something simple but powerful. Markets fluctuate, businesses grow. When you focus only on prices, you experience emotional turbulence. When you focus on value, strategy, and time, you experience compound growth. Daily checking also creates comparison. You see headlines about someone doubling their money on a trendy stock, and suddenly your carefully planned portfolio feels boring. But wealth is rarely built through excitement. More often, it's built through consistency, patience, and disciplined decisions repeated over years. Here's a mindset shift that changed the way many successful investors think. Imagine you owned a small bakery in your neighborhood. Would you ask someone to tell you its value every 5 minutes? Of course not. You'd focus on serving customers, improving operations, and growing profits. Yet when we own shares in great companies, we obsess over minute-by-minute price movements instead of long-term business performance. The irony is that the investors who watch their portfolios the least are often the ones who achieve the best results. They understand that market volatility is normal, emotions are temporary, and compounding needs time, not constant attention. So the next time you feel the urge to refresh your portfolio, pause and ask yourself, am I gathering useful information, or am I simply seeking emotional reassurance? That single question can separate an emotional investor from a disciplined wealth builder.
A powerful reminder that mastering your emotions may be just as important as mastering your investments. If this conversation challenged your thinking, subscribe, share it with another investor, and join us next time as we explore the psychology behind smarter wealth-building decisions.